There we go. All right, we got people coming in.
Good.
Hi, everybody. We're going to give this just one more second. Still people coming into the session. All right. Looks like we're evening out now. So welcome to the first session of the Money Matters series in 2021. I am Andrea Krupp. I am the Director of Planned Giving for Providence College, and I'm a recovering attorney. I went to law school and decided to do development work after many years of practice. So I did land here 2 years ago and love this job. We have a number of people in the group, and I know there'll be questions tonight. If you go down to the bottom of your screen, you'll see a Q&A button. That's where you can post questions to us. And as we go through, we'll keep track of those and answer them as best we can. There's also going to be time at the end for questions. So you don't need to save them. If you want to type them in as you think of them, go right ahead. Otherwise, you can ask them at the end. Like I said, this is the first of a 3-session series. And tonight we have the amazing group of women that I'm so proud to introduce. Kathy Entwistle, class of 87, Barbara Bolello, class of 94, and Maggie Gendreau, class of 2010. This session, this whole 3-session series is built for me. I did this because it's the questions that I've always been afraid to ask about finance, about, what does a stock mean and how is that different from a bond? And when I look at my 401k statement, what am I supposed to be looking for? What decisions am I supposed to be making? And who do I even ask about this? So this is a place of, it's a safe spot, no judgment, lots of good information. Feel free to be comfortable, ask questions, and just learn. So ladies, thank you so much for joining us tonight. I'm thrilled. You guys are the epitome of intelligence and grace, and I'm going to turn it over to you to teach us about finance.
Great, thank you. You all can hear me, I assume.
Yes.
I'm Maggie Gendreau, so I'll just play our presentation. So I'll just share my screen. You would think after a 1.5 years of the pandemic, I could get this better. So thank you everyone for joining us. I'm really excited to be here. Financial literacy is one of my favorite topics. And I think as women, there's not enough of us in this industry. And I think the latest statistic I saw was that 15% of financial advisors in the entire country are women. And so it's no wonder that we're afraid to ask these questions, or that we don't, we don't feel comfortable asking these questions, because there's not a lot of us to ask these questions of. So I'm really honored to be here with Kathleen and Barbara, 2 other female advisors. So I'll just start with a brief introduction about myself. My company is Gendreau Wealth Management. We have 2 offices, our main one in Farmington, Connecticut, and our secondary one in Westport, Connecticut, but we do work with clients across the country. So please don't be intimidated if you have any questions after this to give me a shout if you don't live in Connecticut. I help everybody. we have all of my information is up there on our website, johnderwealth.com. We have a great blog, which I try to demystify and make a lot of these topics that I get questions from my own clients more accessible and digestible. So that's another great resource for everybody. And I have some colleagues that run our social media, which you see up there. And that's another great place for demystifying some of this really great little tidbits on our social media. So please follow. I've been in the industry over a decade now. I started on Wall Street. So I went to Providence College. I then went to the London School of Economics for my master's. And then I started at Barclays Bank right after Lehman Brothers was bought out by them. So as you can imagine, it was a really interesting time for me. And I learned a lot. My last gig on Wall Street was with JP Morgan, at which time I met my mother-in-law, who had a financial advisory company in Connecticut. And it was so neat to find another woman in the industry. And I loved what she did because she actually helped people. I was working with very, very ultra high net worth clients, like think about football team owners, and wasn't really working with them. I was working with their family offices, right? So I really wanted to help people. And I would attribute my time at Providence College to that. And so I joined Lori 5 years ago now. And at the end of the year, I will be a full owner of the entire practice. So very excited to be here tonight. I think I'm going to end it there and turn it over to Barbara.
Good evening, ladies. Thank you so much for tuning in. My name is Barbara Bolello. I am a proud member of the class of 1994. For those of you who can recall, that is the year we won the Big East tournament in Madison Square Garden, where yours truly was on the floor creating mayhem, which is normally what you do when you just graduated college. I graduated in 1994 with a double major, history and secondary education. I always thought I was going to be a history teacher until one of my girlfriends from PC joined a brokerage firm in actually White Plains, New York, said financial services is pretty cool, you should check it out. And here we are in 2021, and I have been in the industry for almost 3 decades, 27 years. I'm currently at an organization called Regent Atlantic. We're an independent wealth management firm. I spent 2 decades at the larger banks, and I'm really enjoying myself at Regent Atlantic. Been there for about 4.5 years, and I'm really excited for the opportunity to speak with all of you tonight. So thank you again. Kathleen?
Thank you. Hi, everybody. I'm Kathy Entwistle. I graduated in from Providence College with an undergraduate degree in finance. My dad was like a CEO of a company, and I was like, I don't know what to do as a major. I said, major in finance. If you understand money and you understand numbers, you can do anything. And I learned to really love how numbers work. I love puzzles and I love helping people. And so I think for us, being able to help people figure out their financial lives and make a positive impact is a huge win, I would say, for all of us here on the panel. My husband also graduated from Providence College. If going to the basketball theme, 1987, that is when Rick Pitino took Providence College to the Final Four in New Orleans. It was a big year. So I also graduated with Billy Donovan. And what I would say also, 2 of our kids went to Providence College. My husband's father and sister went to Providence College. So like many, many Providence College families, we have like a long history and a legacy there. I love Providence College. I learned a lot during my time there. I think the development of Western Civ helped tremendously with my strategic thinking. And I started out at a bank, Manufacturers Hanover Trust Company, started a family. I could not for the life of me figure out how to work and be a mom and do everything at the same time. So I stayed home for 12 years. I started to raise the kids. I volunteered in the community. I made a lot of really wonderful friends. And after my youngest went off to first grade, I went back to work. And what I would say, it was interesting because our life experience, like what we do day to day, gives us a lot of knowledge and insight into this business, like how it works and what's important to people is really what we're trying to solve. And one thing that I know all of us want you guys to understand is like money is something that we just want everyone to get comfortable with. The conversation around finance And it's like anything else, if you practice it like a piano, eventually you get better at it. So you just have to stick to it a little bit. And we're really grateful and thrilled for you to be here tonight to learn a little bit more about financial topics.
Thank you. So obviously, phenomenal women here. I'm humbled to be part of it. So the first section we're going to go through is types of investment vehicles. So a lot of the vocabulary that you might hear thrown around, a stock, bond, mutual fund, ETF. So I'm going to turn it over. I believe it's Barbara taking care of this one. And so these are some things to jog your memory, Barbara, but obviously take it away and demystify these vocabulary words.
Thank you very much, Maggie. And Kathleen, if the practice makes you really good logic applied to golf, I'd be a very, very happy lady. So again, thanks everybody. Kathleen, Maggie and I have been doing this for a long time. And we take for granted, matter of fact, some of the language that we use in our everyday lives, for some of us for multiple decades. And so I find that breaking down some of the jargon that we use on a daily basis can really help folks to try to understand what we do for a living. And not only that, how you can be a good supporter for yourself, right? As you think about your own wealth. And when we think about wealth, as some of you who are older know the old Sims commercials, an educated consumer is our best customer. We like to talk to people who are open to understanding sort of the building blocks of investments and finance, because to me, the more information people have, the more confident they are about their wealth, and it's a little bit more comfortable position for people to be in. So Maggie, Kathleen, and I are going to springboard you softly into the world of investments, again, by starting with the building blocks of investing, the ingredients to the recipe, as it were. So when we think about investment vehicle, again, it's another jargon term. And what we mean by that are simply stocks, bonds, mutual funds, exchange traded funds, and the like. The way that I'd like for you to think about this is I like to call it, I don't know if those of you, I know go to PC, but we have an excellent hockey team. So if I can use a hockey reference, I like to call it a mental Zamboni. So clear that spare ice from your mind, open your mind, and be ready to receive some pretty cool information. When we think about a stock is a unit of fractional ownership of a company. So if we take, for example, everybody's, favorite phone, if we look at Apple stock, for example, probably most of you who are invested in the market probably own some portion of Apple stock. And what that means is you do well, right? Your ownership or your shares do well when it goes up. And when it goes down, you sort of suffer that consequence as well. And so what it is, simply put, is it is your piece of the pie. And with a company like Apple, who's so huge, it's a fractional share, a fractional unit, or a fractional ownership. And so you'll look at the exchanges, which Kathleen will get into after this. But essentially what companies do, if you have a private company and a private company wants to go public, what they'll do is they will issue stock. And what that stock will do is that stock will bring in investors to raise money so that they can grow their company and invest in their own business. With that, when you think about stocks, some companies basically distribute profits in the form of dividends. So they reward their investors by paying cents per share to you in the form of cash. So that's a nice little bonus as well. So when you hear the word stock, you now know it is a fractional ownership of a public company. Bonds. Bonds always get people confused. And I don't think that it's that confusing when you really do break it down to what it is.
It's the math part.
It's the math part. That's right. And people hear fixed income and bonds and, all of a sudden it's like, check, please. So when you think about fixed income, it's exactly what it is. It is something, one of these investment vehicles that's going to pay you a fixed amount of income on your investment. When I break down bonds, bonds simply put are a contract between, let's say, an organization and an investor. An organization says, and let me use, let's use the city of Providence, for example. The city of Providence says, we would like to raise $100 million so that we can improve the various bridges in the city of Providence. And so investors say, okay, tell me more. And the city of Providence says, okay, if you lend me, investor, $100,000, I will pay you back that $100,000 plus interest. And that is the fixed income piece of it. So twice a year, in the form of a coupon payment, we call it, you receive interest on that contract that you entered into with the city of Providence. So that's really what it is. It's a contract between two parties. Now, when we think about fixed income, it could be City of Providence, a municipal bond. It could be IBM, which is a corporate bond, or it could also be with the US government in the form of a treasury bond. They're all the same, okay? There are different tax consequences for investing in those three, but I am certainly not going to go down that rabbit hole tonight. If anyone has any questions on the taxation of bonds, please let Kathleen, Maggie, or myself know. So when we think about fixed income, it's got four purposes. One, you want to collect a fixed income. Two, bonds don't generally move that much, so you think about safety. Three, they could also be a really nice placeholder for cash, which isn't really paying that much currently. And four, from a tax management perspective. So
And
again,
Barbara,
we could, yeah.
Oh, sorry. Could you, I think a lot of people think of risk and not risk. Can you talk a little bit about that with stocks and bonds? What might be riskier and what might not be?
Absolutely. I would say that if you were to think about stocks relative to bonds, stocks are a little bit riskier in that they can fluctuate on a daily basis, where bonds tend to move not that much. And that's what they're intended to do. A lot of folks, a lot of portfolio managers use fixed income as a principal preservation piece. So we want to make sure that when the market is bumping up and down, we've got some kind of shock absorber in a portfolio. And that's really in the form of bonds or fixed income, which are intended not to move too much. Another type of investment is a mutual fund. And everyone who has a 401k probably has a mutual fund in there. I've spoken to clients, new clients who have come to me from different places, and they've been investing in the market for decades, and they don't know how to describe a mutual fund. So let me be, hopefully, the first person to demystify mutual funds for you. And the way that I'd like to do that is by using Trader Joe's as an example. And I know that Trader Joe's is, I think, in about 45 states. And if I did the math, I'm assuming that the 5 states that don't have Trader Joe's, people aren't calling in from those. So the way that I think about a mutual fund is I think about it as a bag of assorted nuts. And that bag of assorted nuts is like a mutual fund. A mutual fund can be a whole bunch of different things, either stocks or bonds, packaged to achieve a goal, right? If we think about Trader Joe's, we've got a Trek mix, which is cashews, almonds, and chocolate. And then we've also got other mixes that might have cranberries or raisins or what have you. Each one of them is packaged differently to serve a purpose. Sometimes you want sweet, sometimes you want salty, sometimes you want energy. Each of these mutual funds, again, are a bag of assorted nuts. We like to refer to them as baskets. So what happens here is that mutual fund managers take a whole bunch of different investments, let's say a whole bunch of stocks, and they say, these stocks are growth stocks. They put them in a bag and they call it a growth mutual fund. Guys and gals, that's all it is. It is a bunch of different stocks or a bunch of different bonds bucketed to achieve a certain goal. Maybe it's capital growth, maybe it's income, whatever the case may be. So just think, when you're talking about a mutual fund, think of a bag of assorted nuts. When you don't know what is a mutual fund is typically 5 letters in the symbol ending with the letter X. That is what is known as a mutual fund. One of the things that Kathleen, Maggie, and I point out to our potential clients, for example, is how much are you paying the fund, the person who put together that bag of assorted nuts? A lot of people don't know what they're paying to invest in a particular mutual fund. Let me help you demystify that. Go to Google, take that symbol, put it in Google, and it is going to tell you what an expense ratio is. And that's how much you are paying the mutual fund manager to manage that investment for you. So you guys will hear companies like BlackRock, PIMCO, Charles Schwab, they all put together their own bag of assorted nuts. The other thing about mutual funds, and I'll tick into ETFs or exchange traded funds, both mutual funds and exchange traded funds are similar. What they do is they allow for diversity. So instead of buying that share of Apple, you can buy a mutual fund. You could buy an exchange traded fund. That Apple share only gives you exposure to Apple. So if something happens to Apple and it goes down, you lose the value of your Apple share. With a mutual fund or bag of different investments, they're all going to fluctuate within that mutual fund. So you're basically limiting the amount your investment goes up or your investment goes down. Exchange traded funds are essentially a conglomeration of different companies, different stocks designed to mimic an index, an asset class, a sector, what have you. People will say, Barbara, Kathleen, and Maggie, what's better? What's better for us, a mutual fund or an exchange traded fund? The answer is, and not to be cheeky, we don't know, because we don't know your particular situation. So depending on where you are, how tax sensitive you are, how sophisticated you are, one mutual fund or one ETF might be better for your particular financial situation. To close my segment of the presentation, to let you know, when we think about these types of investment vehicles, stocks, bonds, mutual funds, and exchange traded funds, any good portfolio manager will treat all of those investments like him or her are the maestro, right? The maestro or the conductor of the orchestra. That portfolio manager is going to go ahead and make sure all of those different types of investments play beautiful music together in your portfolio. They can all be working together and should be working together if your portfolio is diversified and thoughtful and tax managed. So I hope that's helpful to people. Hope it wasn't too scary. Happy to always talk about Trader Joe's and food, especially at 6:30 in the evening. And I will turn it over to Kathleen.
Barbara, I was just gonna say, I'm hungry and you talked about food.
Maggie, can we just stop for 1 second and
Yes.
see if anybody has a question? There's, again, just want to remind you at the bottom of your screen, there's a Q&A button. And so as we're going through this, anybody who has a question, there we go, one question. It says, is there any particular platform you would recommend for investing over another, i.e. Vanguard, Stash, etc.?
Who wants to take that? I'm happy to answer it if you guys want. Since I'm up next, I can. Hello, is it Sadia? Nice to meet you, and it's great to have all of you here tonight. If you guys have questions, definitely keep asking in the Q&A. I was typing in the chat apparently. Okay, so one thing I would say, Sadia, is everybody is different, and it's very hard to give a one-off recommendation like, oh, you know, call Barbara or Maggie or go to Vanguard. I think it really matters the most, depending on how much money you have, how much handholding you need, how much advice you want. And, you know, some of the platforms give you no advice and you just kind of have to go along on your own. If you're the kind of person that appreciates guidance and wants some support to make sure that you're on track, then I would say, you know, finding a financial advisor would be a better route. If you're, you know, that's my personal opinion. I have, you know, children ages 26 to 31, and I love to talk to them because I think sometimes the younger people think that, you know, I don't have so much money, I can't get an advisor, or, oh, I know so much about Stash, or I'm just going to do some, you know, Betterment, something along those lines. But I would say those programs are designed to cookie cutter investment solutions for you. And it's not necessarily designed for your specific situation. And you will not necessarily get support or advice, which, believe it or not, over many years, having support and advice can make a big difference. So I don't know, I would say when you go to the doctor, would you rather like go to one that's giving the same advice to everybody, or would you rather go to one who's listening to what your you know, sort of ailments are and coming up with a plan that makes sense to heal you the best?
Kathleen, if I could chime in, I totally agree in terms of, do you want hand-holding or not? But if you, let's say you don't, let's say you're like, I just want to play around on my own, then you want to look at fees, which Barbara mentioned a little bit in her presentation. So you're going to want to look at who's charging a platform fee, right, just to open the account, who's charging a fee to trade, so on and so forth. So if you genuinely just don't want assistance, even though I totally agree with Kathleen, I think investing is beyond just picking a stock, bond, mutual fund, or ETF. It actually should be part of a bigger plan. Why are we investing? What are your end goals? How much do you need before retirement? How much do you need to buy a property? So on and so forth. And that's really a lot of the value of us financial advisors. But if you are going to go off on your own, then certainly look at those costs, because nothing's free, right? I think I learned that in my economics class, no such thing as a free lunch. So cool. So Kathleen, I think you're up. The market, what does that mean? I don't even know.
Sure. So I would say too, just to tag on to Barbara's great explanation about the different parts of the market, I like little tricks. So my trick is, I always say, if you own a stock, you're an owner. You own part of the company. And if you own a bond, you're a loaner. You're lending your money out, but you don't own the company. So owner or loaner, I think, is an easy way to remember between the stocks and bonds. I hope that's okay. It's my little quick thought. Okay, so the market, yeah, everybody's like, what's the market? And why is the market doing so well when the economy is doing so terrible, right? Like the market had an incredible run up over the last 15 months. The market is made up of the companies that are doing business, whether it's in the United States or abroad. And the S&P 500 is something that a lot of people will talk about if you listen to Bloomberg or CNBC or any of the financial shows, or sometimes just in conversations with friends or at cocktail parties. So the S&P 500 is basically an index, and an index is something that we just use as a benchmark, a comparison. Like if my stocks are returning X percent, how does that compare against the S&P 500 stocks or companies? And it's just our way to benchmark if we're doing well or not. So the S&P 500 stands for Standard & Poor's 500 large size companies that are added to this index to help benchmark how the general US companies are doing overall. Are they making money? Are they losing money? The stock price of a company is really based on how much money they're earning and what their profits are. And that's really what you're looking at. A lot of times it's based on where do we think a company is going forward. So Barbara was talking about Apple. Apple might be at, I don't know, $140 or $150 a share. And if we think Apple is coming out with new products, or they're coming out with new, better improved products, or better pricing, better systems to make things cheaper, and they can still make money, then we think the stock price will go up because their earnings are going to go up, and that all affects the price of a stock. So it's really about purchasing companies that you know, you're comfortable with, or that have been researched by somebody you trust, and you're investing with the idea that you will get some growth in the value of your investment. So S&P 500, basically stock market index tracking the largest 500 companies in the US market. And it's important to you only because it's used as a benchmark. We also have, you guys may have heard of like the Dow Jones Industrial Average. Dow Jones makes up 30 stocks. It's been around for a very long time. And it's just, again, taking into account some of the bigger name companies in some of the different areas of the market, whether it's, so there's financial companies that could be like banks or insurance companies. There could be healthcare companies. There could be consumer staple companies, like where, you know, companies that make cereal or soap or shampoo. So there's different companies out there, and a lot of them are brought into these different indices, and it's just a way for us to benchmark, you know, how are companies doing in today's economy, and how is my own particular portfolio doing compared to the general benchmark or way that the country or companies in the country are doing. So the S&P 500, the Dow Jones, and there's another one called the NASDAQ, but those are the three that benchmark US companies. The Msci World Index is one that benchmarks exactly like it says, the world. There is a tremendous amount of companies, 1,583 companies worldwide that are part of that benchmark. Again, it's just getting an idea of how everything's doing around the world. So there's times when the US is doing really well and say Japan's not doing well, or China's doing better. So this is a general overall, how is the entire world markets or economy doing based on how the companies that are producing goods and services are doing, if that makes sense. And then Barclays Aggregate Bond Index is a benchmark for basically, you know, bonds, and it could be, it's made up of corporate bonds, like corporations that issue bonds. The government, the US government issues treasury bonds. There's mortgage bonds, and there's municipal bonds. So that just is a measure of how bonds in general are doing. So the idea is, like with an index, you think about comparison, right? Anytime you compare, am I doing better or am I doing worse? So if you know that the S&P 500 has returned close to 20% this year, and you have all of your money in stocks as well, and yours has returned 10% this year, you would want to find out why you've only received the half of the return that in your portfolio that the benchmark has. You've underperformed the benchmark. You want to find out why, and then see if you can have your portfolio repositioned to do better. The last thing I'll just say, and then pass it off to the next person, which I think is Maggie. But one thing I'll say is women in general, we are very well known, not only for having like less percentage of representation in the financial world, but we also don't like to take risk. And we think by not taking risk, we will do better. Let's put our money in the bank. Let's save it. But the truth of the matter is, if we take long-term money and save it and don't invest money that we have for long-term needs, we're actually taking more risk by not investing it for the long term. And my last little trick will be to tell you, if you have an emergency fund, which is cash in a bank or easy liquidity, like easy access to cash, and you have enough that covers 6 months of your living expenses, when the markets go up and down, it's not as scary because you know that you are not going to be put in a position to have to sell your stocks all of a sudden to pay for bills, because you have an emergency fund for your short-term needs and your unexpected needs versus investing for long-term, like retirement or a big goal that you have in the future. It could be just financial independence. And that's everything I have. I see there's a Q&A. I don't know if there's something.
Kathy, I just have one quick question before we get to that one. So the S&P 500, the Dow Jones, and the NASDAQ
Mhm.
are all indices, right? How do you,
Yes.
and benchmarks, how do you know which one you should be looking at as the benchmark? So
Right. I'd say most people use the S&P 500 generally as the benchmark because it's got 500 companies. So it has a lot of US companies. There's the NASDAQ is more of the newer, typically the newer companies, the growth companies, the up and coming companies, the tech companies that started years ago. It used to be quite often that if you saw a company, they have what they call stock symbols. So if the stock symbol is 4 letters, it usually means it's being traded on the NASDAQ. And the NASDAQ, again, was a newer exchange for more of these more growthy type companies or newer, up and coming that might not have met the qualifications to be listed on the New York Stock Exchange, which is like a bit more established and have been around longer and is sort of like, think of it like, more buttoned up, and maybe they have rules and you have to like pass the rules to get in. So they usually had 3, sometimes it's 1, but 3 letters. And that those were like a way to quickly identify if it was on the New York Stock Exchange, their symbol would be 3 letters. And again, NASDAQ, it was like, well, these are the ones that they can't get into the New York Stock Exchange. They don't meet the requirements. So they like joined the NASDAQ, and then they stay because there's loyalty and sort of like more modern current feelings sometimes to that.
And if I could jump in on one thing too, I don't know if it's fair to always compare yourself to any one of these indices. Barbara mentioned diversification. So if you're just looking at one mutual fund and it's all US stock, then perhaps, yes, you can compare it to the S&P 500, which Kathleen said is all US stock. But if your mutual fund is a emerging market or a Europe mutual fund that's investing in stocks abroad, you might want to compare it to the Msci World Index. Same thing is true of a bond mutual fund or ETF. You'll want to compare it to the Barclays Aggregate. So
right. I think that's a good point.
Yeah. And when you look at a whole portfolio, it's going to be a lot of different things in there. And depending on your risk tolerance, as Kathleen mentioned, you might have 50% in stock and 50% in bonds. So you'll want to look at both the Barclays Ag and the S&P. So I think, at least for me, I always encourage clients to look at these because they're important to know what's going on in the world. But also it might, just because you're not beating the S&P 500 doesn't mean you have a bad portfolio.
Yeah, no, that's great. I'm going to just add one more thing to that because I think that's a great point. You do want to make sure that you are diversified, first of all. And I'm going to use a food analogy because we're on food analogies tonight. And I think we've all made at least one cake in our lifetime. So I always tell clients, like, look, you want your portfolio to be diversified and have all the right, investments in it. And like a cake, you have to have the right ingredients. So you need your flour, you need your sugar, you need your eggs, you need, your oil or butter. And if you're missing one of those ingredients, if you don't put the flour in, your cake's not going to rise. You're not going to have a cake. It's not going to be what you expected. Or if you don't put the sugar in, right? If you leave an ingredient out, it's an issue. It's not a cake. And if you don't put the right amount of the ingredients in, like, oh, I put 10 eggs in, why doesn't it taste so good? You put too many eggs in, right? And the idea is you can also do the same thing with your portfolio. You want a little bit of large size companies. You want some middle-sized companies and smaller sized companies. You want companies internationally. You want bonds. So having a little bit of everything in your portfolio, well thought out and well designed, can actually be better for you over the long run. And you also want to make sure that you're benchmarking your portfolio against the benchmarks based on the portfolio that you're creating for yourself or someone's created for you. So I think those are all like really good points.
So the
So
question
if I
that
may,
we got
gals,
in
we have a
was-
question about Bitcoin. And again, to reuse my language, at the risk of sounding cheeky, Susan, it's a very specific investment that Maggie, Kathleen, and I are not permitted to advise on a particular investment. If you want to inquire about Bitcoin and sort of dig in a little bit more, we're happy to talk to you offline about it, but we certainly would not be able to answer that question in a general audience. So please accept our apologies on that. Go ahead, Maggie.
Thank you. That I was just going to say that the question, so that I agree. Perfect answer. So section 3 is my section that I'm leading, and it's account types, but Barbara and Kathleen, feel free to jump in. So as of right now, we learned, what I love Kathleen's baking analogy. So what are we putting into the cake, right? We're putting in mutual funds, we're putting in stocks, we're putting in bonds, whatever is right for your risk tolerance. But what are we putting into? What is the pan or the sheet cake, the pan that we're using to bake? And that's account types, right? So often people come to me and they tell me, I have an IRA. And I'm like, oh, okay, so how are you invested? And they're like, in an IRA. And they don't realize that it's mutual funds, stocks, bonds that go into an IRA. So I'm going to talk about those. These are all account types. So these are not actual investments. An IRA is not an investment. A 401k is not an investment. But again, it's rather that baking pan that we're putting our investments into or putting our ingredients into. And the way to think about this is probably everybody, I'm going to use Barbara's example. Actually, she shared this when we were prepping. Everyone's probably familiar with a checking or savings account, right? You go to the bank, you open it up, and you put cash into it, right? So think of that, think of these accounts that I'm about to talk to in the same way, except you're putting cash in it, and then there's another layer where you're investing that cash. And so the first one is an individual retirement account, or known as an IRA, or sometimes known as an IRA. And there's 2 different types you'll see, a traditional IRA and a Roth IRA. I'll come to a Roth after. So for traditional IRA, anyone can open it, as you can see on the screen. So you don't necessarily, your employer doesn't need to open it for you. You can go to a Vanguard, someone brought up on the call, or a Stasher, or you can come to Barbara, Kathleen, or I, and you can open an IRA, even if it's not associated with your employer. And I think that's important. I've worked with a lot of residents in out of medical school, and I've worked a lot with a lot of people in medical school, and they have earned income. So whether it's through their residency or through something like that, they're earning money, but because of their position, they're not able to yet access the company 401k. So, which is obviously a type of retirement account. So they always think like, I can't save for retirement. And that's not true. As long as you have earned income, and as long as you're a US citizen or legal alien, you can open an IRA. And so that's great news. It doesn't exclude people from saving for retirement. And let's say you're not working, right? You took time off to take care for the kids, but your partner is working. Your partner can actually make what's called a non-working spousal contribution into an IRA for you. So that's really important, not to be gendered, but historically you did see women stay home with the kids while their partner was off working. And, people get divorced, right? The divorce rate was 50% at one point. And women were thinking, I never saved for retirement. So, go back if you find yourself in this position and talk to your partner and say, hey, why don't we make a non-working spouse contribution on my behalf? And if depending on how much you earn, it could actually help your taxes too. There's limits on that. So anyone can open it. That's great. The next thing is your investment lineup. So it certainly depends who you open the account with. But in my experience, pretty much every platform is going to let you invest in the full gamut. So you want to buy Apple stock, you want to buy Tesla stock, you can. You want to buy a mutual fund or an ETF, you also can. So that's what the beauty of an IRA is. It's really flexible in what you can purchase as an investment, which is great. And it differs a little bit from your 401k and other retirement accounts. Just so we know, the contribution is smaller than that of your 401k, which I'll get into on the next slide. So for 2021, the maximum you could put into an IRA per year is $6,000 if you're under 50 years old. And if you're over 50, you get a $1,000 catch up. So the most you can put into an IRA in 2021, if you're over 50, is $7,000. And lastly, just so you know, accessing this money is a little bit more difficult than just a normal sort of investment account, which I'll touch on in a minute as well. So we encourage our clients to put money into these retirement accounts, but then not to touch it until they're at least 59 and a half years old. With some qualifying exceptions, such as buying your first home, education, disability, and passing away, I think that's all of them, you would have to pay 10% penalty if you take out the money from this account before you're 59 and a half years old. Plus, you'd have to pay taxes. So I really encourage you, if you have an IRA, to speak to a professional before you decide to take money out. One, because if you're under 59 and a half years old, there's a penalty. And two, because if you're over 59 and a half years old and you're able to access this, you have to pay ordinary income tax on the money that comes out. So it can have an impact on your taxes. So you might think, well, it's going to impact my taxes. Why do I open it? Well, one, you can borrow for anything in life, but you can't borrow for retirement. And two, money in these accounts actually grows tax deferred. So you're not paying taxes on the money year over year, but rather until the money is coming out. So that's a really great benefit. Moving on to the difference now, 401k, 403b, 457. There are slight nuances between these accounts, but for our purposes today, know that they are retirement accounts that come through your employer. 401k is if you work corporate for a private corporation. 403b is for nonprofits usually and NGOs. What many people don't realize, if you work at a hospital, a lot of those are nonprofits. So, or they're structured that way. So you get a 403b. And 457 is primarily for government workers. Again, there's slight nuances, especially with the 457, but in general, what I'm talking about here apply to all three. And you might think, what are these weird names? They're after the tax code. So the 401k is a tax code. And for your purposes, you get this through your employer. And your employer might make a match. And I always think of match as free money. Essentially, your employer will say, hey, Barbara, if you put in 5% of your income into your 401k, that's great for you. You're saving for retirement. But if you do that, I will match that 5%. So let's say, for easy numbers, 5% of Barbara's salary is $10,000, and that's what she puts in per year. That means her employer, Providence College, is going to put in another $10,000 because she's matching what Barbara put in. And so if your employer walked up to you without thinking about a 401k or anything and said, hey, do you want $10,000 extra? You would say, of course. And that's essentially what they're saying to you, except that you have to put it into this account. And they're doing that to encourage you to save for retirement. because long gone are the days for most people where they have a pension. So you work 35 years at an employer, you leave, and then they pay you for the rest of your retirement. Instead, employers are putting this into the hands of us, their employees, to save for ourselves for retirement, but they do give us that incentive of match. So it's really important to at least put in enough for your match. Now, the investment lineup here is typically more limited, and Barbara touched on this in her part of the presentation, where you're probably going to have 20 mutual funds that you can choose from. That's intentional. You get 20 or 30 or maybe 10, and that's in order to not overwhelm the average investor. You know, the regulators assume that this isn't your day job like it is ours, but it usually is enough to also achieve that diversification that Kathleen was talking about. So again, you can talk to one of us here offline if you wanted to go through what your investment lineup is. And I do believe in our next session, we're going to show you how to do that yourself as well. So the difference here is your contribution for 2021, which, by the way, it was raised slightly for 2022, but your contribution can be a lot greater. So $19,500 a year if you're under 50, and then you get a catch up of $6,500 on top of that if you're over 50. And the reason you might want to put away this much money is because it comes out of your income before your paycheck even hits your account, and it's not considered taxable income. So it's going to help you save for your taxes, which is huge. Lastly, the same withdrawal rules apply. So you want to let your money grow here until 59 and a half. If you take the money out early, there is a 10% penalty. Again, after 59 and a half, you would pay ordinary income tax. One thing I didn't mention in the IRA, but it is true of the IRA and of a 401k, et cetera, is that once you hit 72 years old, you must start taking out the money. Even if you don't need it, you know, some people do still have pension, Social Security, that's enough for them to live on. You still have to take out the money. And that's because the IRS would like to tax you on it and finally get their tax dollars after it growing for 35, 40 years, tax-free or tax deferred. And so if you don't do that, there's another penalty. And so it's really important that you take out the correct required minimum distribution, also known as an RMD, at 72. And again, that's something that Barbara, Kathleen, and I help with.
Maggie, I'm going to jump in. Can you go back for 1 second? So on those withdrawals, this is my area, and we'll talk about this in the third session, but just since we're here, those required minimum distributions at 72 can be used to gift to charity, and they're not taxed if you gift them to charity because they're not considered income. There are very specific ways you have to do that, though, and we can talk about this again in the third session more specifically, but it must go directly from your broker, whoever's holding your IRA, to the charity. So if it's Providence College, it goes directly from whatever company is holding your IRA to Providence College without touching your hands at all, and it's not included in your income. You can also do that when you are 70. No, you can do it after 59 and a half, right? When you can take your, what's the minimum age, Kath? I'm blanking.
Not as a charity. You can't do a charitable. You can take money out at 59 and a half without a penalty, but you can't do it as a charity. It has to be over. I think it's it's over 70. Yeah.
70.
Mm-hmm.
So those, just so you know, there you can use this as an investment.
As a giving tool,
Yes.
a giving tool, and I think it's capped at 100,000. But
yes,
I'm not. Yeah. Mm-hmm.
Per person.
Mm-hmm. So it is a great, well, so, and to Maggie's point too on that is, you know, if you're taking out $100,000 out of an IRA and the government's taxing you, if you're in a 40% tax bracket, $40,000 goes to the IRS and $60,000 stays in your pocket. If you gift it to a charity, the entire $100,000 goes to a charity and there are no taxes to be paid. A lot of people are concerned about getting their income up too high as well because of tax rates, and it also affects a lot of different areas of investments and the way you're taxed. So if you're looking to reduce your tax impact and also give to a charity of your choice, it's a great option if you meet those requirements.
And that is only with an IRA, not a 401k, 403b, or 457. So just
Correct.
Perfect. Sadia also asked a question if there's any specific books or online resources we recommend. One of the books that I love to give to clients, and especially when their kids are interested in learning more about this, is the book by Rami Sethi called I Will Teach You to Be Rich. It just talks about some really great basic principles about how to start investing, what to think about with financial planning and long-term goals. So I love that. I do encourage you to go to my John Doe Wealth and our social media. We always are posting resources there. And I can also, the podcast that I personally like listening to is The Indicator. They're 10-minute sessions. You can get them where podcasts, anywhere you listen to a podcast, 10 minutes. It's by NPR's Planet Money. And it's just these digestible pieces, and they talk about all sorts of things, I think, in a really, really digestible way. So hopefully that helps. But Barbara, Kathleen, if you want to jump in before I go to the next slide of anything you would recommend, please let me know.
I can jump in. I mean, there are so many out there. There's so many good books, but even something as simple as, the Personal Finance Guide for Dummies. I mean, don't take the word dummies literally. It's just very broken down and in a language that we can all understand. There's also like Broke Millennials. There's Rich Dad, Poor Dad, things like that. The Intelligent Investor, Think and Grow Rich. And then there's also like very low key books that, are, and I'm trying to remember the name. It's like Bad ASS or something. I can't remember it, but I will send my thoughts on that too. There's so many great books to read, and also certainly, podcasts too. But I think books sometimes gives it to you in a dose that you're comfortable with a little bit at a time.
Yeah, absolutely. All right, great. So the last piece on types of investment vehicles I want to talk about are Roth IRAs or Roth 401ks. And really the key here is that word Roth. I think a lot of people always want to know what it is. So as I mentioned, in the traditional IRA or just a pre-tax 401k, you basically are putting your money in before tax, right? Without getting into the actual semantics of it, but just think about it that you're deferring your taxes, right? You're not paying them today, you're paying them in the future. Whereas with Roth IRA or Roth 401k, you're paying your taxes today, right? So people might think, well, why don't I want the tax break? Why would I do this? And the reason you would do this is because your earnings, so the amount that your money grows, you don't pay taxes on it. With the little caveat you can see here that you held the account for 5 years, and of course, that 59 and a half years old piece still applies. The one exception is any money that you put in, any principal or the money that you put in to a Roth IRA can actually be taken out if the account's been open for 5 years. So a very simple example, if you put 10,000 into a Roth IRA and it grew to 15,000, you could actually take out the 10,000 and leave the growth, which is that 5, right? 10 plus 5 is 15. So that's an exception too. But what you really need to know here is that you pay your taxes today and they grow tax-free. And another beauty here is there's no required minimum distribution as long as you live. So this money can grow forever and ever until you pass away. So this is a really great tool for gifting to beneficiaries, meaning maybe your kids, your nieces, your nephews, but also your favorite charity. You can name Providence College as a beneficiary on any of these accounts. So that means that if you were to pass away, whoever you named, and you can name multiple people and different percentages. So I'm not saying give your life savings away to Providence College, but you could put 1% to PC and it will surpass probate and go to those places in a relatively efficient way and not get caught up in court. So just things to think about. And the last piece that kind of ties into that, so there are other investment vehicles, but we wanted to talk about retirement ones because that's what most people at least have, right? They either have a 401k or something like that, or an IRA. You don't necessarily need to open a retirement vehicle. You could just open what we call just an individual account, or with your partner, a joint account. And you can also invest there, and that money doesn't get earmarked for retirement necessarily and can be accessed sooner than 59 and a half. So just know that exists. But one last thing, because this is, being sponsored by PC's planned giving department, is we wanted to bring up a donor advised fund. So a lot of questions I always get asked is, how can I lower my taxes? And, with the new Tax Cuts and Job Act under President Trump, taxes became much more simplified when you were filing them. But that also meant there was a lot less opportunity for tax write-offs. Most of the country would just take that standard deduction on their taxes. But one of the ways I already mentioned is, and again, talk to your tax accountant. I'm not a tax professional, but one of the ways that you can get a tax break is, of course, putting money into your 401k, as I mentioned. But another tax-friendly vehicle is a donor advised fund. And they're really, really easy to open. So essentially you open it, and if I opened it, I'd call it the Maggie Jondro Donor Advised Fund, or Maggie Jondro Foundation, essentially. You make a tax deductible donation into this fund. Your donation grows tax-free, and you get to support charities you love now or over time. And you don't have to give to the same charities. You can give to multiple. You don't have to give every year. And so you might say, well, why do I want a donor advised fund? Well, the beauty is you can fund it in a much greater bulk. So let's say you put $20,000 into a donor advised fund this year, and that $20,000 is a tax deduction in the year you fund it, and you can give to your favorite organization over the course of 10 years. So let's say you want to gift to Providence College $1,000 every year, and you're going to do that, and you've already earmarked that in your budget. Well, if you can, why not take $10,000, put it in a donor advised fund, let it grow in the market, and then continue to make that promise that you've pledged every single year to PC. So again, these can be a little bit more complex, but I did want to mention that because if you are charitably inclined, why not be thoughtful and smart about your charitable giving? So you can benefit from it as well.
Maggie, can I add 3 quick notes on the donor advised
Yes.
fund? Number 1, I simplify it to donor advised fund is a charitable checkbook.
Yeah, love that.
Number 1. Number 2, it is a wonderful and very easy way for your kids to understand the importance of philanthropy.
Yes.
They can see the gift right before their eyes. And number 3, a donor advised fund is much simpler and much cheaper to open and maintain than a foundation. Foundations are a different can of beans, and the donor advised fund is a wonderful entree into the world of philanthropy and your own charitable inclination. So very simple to set up, and I'm a huge fan of them because I'm a huge fan of giving to charity. So.
Perfect. And so our last section where we'll all chime in is how did these all fit together? So I've spent some time chatting, so I'm going to turn it over to my counterparts and see if they want to chime in and if we've missed anything thus far.
And Maggie, there are 2 questions in the question session. So if you just touch on those before.
Yeah, one was Brenda.
You can do them at the end. I just wanted to make sure you saw them.
Yep. One was Brenda, and I think that was privately answered. And the other, and I'd love to hear what everyone else thinks about it, was from Miriam. And what do we think about Susie Orman? What's our opinion of her? And I'll start. I think Susie, like anybody, any famous celebrity, sometimes says things to get your attention. That's true of like Dave Ramsey as well. So, like with any piece of media you consume, approach it with a cautious eye. But I also will say that Susie is is a woman in this industry, and she really was a pioneer. She was the first person I saw, talking about this that was a female. So, some of the things I've heard from her are great, and some of the things I don't agree with, but I think that's true of everybody. So I don't know if anyone else has a thought on Susie.
Yeah, I'll jump in. Same. I think like Susie definitely, was like the OG of financial education, I think, for women in particular. So I definitely appreciate that. I would say that everybody is slightly different and you have to take everything with a grain of salt, and what might be good for one person might not be like the right advice for another person. But at the end of the day, it's all about really the first step is getting organized with your money, just sort of collecting all your statements and trying to understand it. And I think she, brought that up quite a bit about the different areas of your financial life that you need to address. And we've addressed some of them tonight. But the most important thing, I think, for any of us is to feel comfortable about money and talking about money. And I would say most people might ask you as their first question, how much money do you have? And I think really the right first question should always be, what does money mean to you? And think about that. Like, what does money mean to you? And if you can really spend some time and identify what's important to you about money, that's a great first step to understanding your relationship with money and getting you more comfortable with, how your money can work for you.
I love that, Kathleen. We talk about our money story. So why do we make certain decisions? Often it has to do with your family story, the way you've brought up, whether it's coming and looking at money from a source of scarcity, you feel like you'll never have enough. And a lot of women have that issue. They're worried about being a bag lady, according to psychologists, or overspending. Like, why do we do that as well? So, and the point of investing and saving is truly it's a tool. So money is a tool to help you live the life you want to live. And so not everyone's going to be the same. I have some clients that live on very little per month and they're happy and that's enough for them and they barely touch their accounts. And I have other clients that spend $20,000 a month and that's what makes them happy. So don't compare yourself to somebody else, but rather come and meet with a professional and help understand your money story, because again, what's right for you is not necessarily right for others. So I think we did a nice job already talking about how everything fit together, but before I move on to the last section, which is just questions, Barbara and Kathleen, do you want to add anything on how everything fits together?
Barbara, anything?
Just very quickly, because I know we are over the allotted time, but just to play on what Kathleen just said, we oftentimes ask our clients, what's the purpose of your wealth? What are you working for and what do you want it to do for you? So as you are, think about over the course of your working years, why are you working and what goals do you have? That's sort of seeing the end of the movie while you're filming it. And I think having goals and objectives that are clearly stated will help you to get to where you want to go. So again, think about purpose. And again, to our audience members, thank you for joining us. This is not easy stuff. We hope we broke it down to you in a way that is digestible. There's a lot here, but please don't be intimidated by it because there are people like us. Call us anytime, email us anytime. We're always happy to help you. We do this every day. So we take a lot of things for granted. And again, it's your wealth. You're working really hard to accumulate it. There's a lot of responsibility. So make sure you understand what you're getting into if you are thinking about working with an advisor or entering into the world of investments. Lots of good questions. Just make sure you're informed.
And I just want to remind people that this is the first of a 3-session series. So please join us on December 15th. We'll be talking about intelligent investing. Same 3 beautiful, wonderful panelists. There's a survey that was posted, I believe, in the chat. So if you would take a second to fill that out, it just helps us. This is how we develop these programs and know your feedback. You will get a copy of the recording in your email within the next couple of days, and feel free to reach out to any one of us. We are here, accessible, and always happy to talk to all of you. Kathleen, Barbara, Maggie, I'm honored to be part of this, and thank you so much for agreeing to do this with us, and I will see you all in a month. Happy
Thank
Thanksgiving.
you.
Thank
Happy
you.
Thanksgiving, everybody.
Happy Thanksgiving, everybody. Thank you so much.
Take care.
Thank you.